David R. Guttery is the president of Keystone Financial Group in Trussville, Alabama. David Guttery and Brandon Guttery are financial advisors and represent Emeritus Investment Company, LLC. Please stay tuned through the end of the video for additional important disclosure information.
Hello everyone, I'm joined today by David Guttery, president of Keystone Financial Group here in Trussville, for a discussion about risks that are having an impact on the market today. David, thanks so much as always for being with us. It seems like the markets have been volatile lately. What can you share with our viewers about risk and concerns that are likely behind this recent volatility?
We are, I believe, at a point of inflection where risks of various types are weighing on the market as we remain relatively near all-time record high levels. Broadly, I would suggest that three main areas of risk are of concern today, but you can add many subgenres of concern beneath each heading. I believe that we're facing significant headwinds in the form of geopolitical, global risks, economic risks here at home, and political risks at the present time. Before we address each category individually, let me suggest to everyone watching that we will publish a much more detailed podcast on our website about these risks over the coming few days.
Well, we'll definitely watch for the podcast to be published. Well, David, let's begin with geopolitical risk. What's happening in the world that might be impacting market volatility?
Well, China remains of concern. Neither the U.S. nor China seems to be fully living up to the tenets of recent trade agreements. China remains an irresistible vacuum for international business. However, it comes with the cost of forfeiting intellectual property and trade secrets. Recently, China has seemingly taken an antagonistic approach. Last week, American ships came into contact with Chinese nuclear submarines off the coast of Alaska. And recently, Taiwan escorted 9 Chinese warplanes from its airspace. If China attempted to assert its will militarily against Taiwan, how might the U.S. and the world respond? Russia remains of concern. Last year, the Trump administration imposed a moratorium on the import of Russian oil. Today, Russian oil imports are up 150% from where they were just 1 year ago, and those imports are met with tariffs. The U.S. is more dependent on foreign oil after many years of self-reliance, as domestic production has declined in the face of tighter EPA restrictions. It is unnerving that the members of the OPEC Plus nations, Saudi Arabia, and Russia all declined the request of President Biden to produce more oil in August. Because of our higher dependency on foreign oil, the Middle East is now back into the geopolitical picture again as well. Given the recent events in Afghanistan, new cultural and religious alliances with the Taliban could potentially destabilize relationships between the United States and the countries of the Middle East, upon which we are dependent for higher amounts of imported oil. And finally, North Korea remains of concern. Just recently, they successfully test-fired the longest-range missile to date. If any of these geopolitical areas of concern were to devolve into a crisis, it could reverberate around the world.
Well, clearly there are global concerns of which to be mindful. Well, you also mentioned having some concerns about recent economic data as well, correct?
Yes. On the inflation front, for the second year-over-year period in a row, we have observed higher inflation at the producer level than at any other time before. From August to August, inflation at the producer level was higher by 8.3%. Said another way, the cost of manufacturing the things today that we will purchase 30 to 60 days down the road increased by 8.3% over the last 12 months. The consumer price index also rose by 5.4% from August to August. That is twice the average rate of inflation that we have experienced over the last 20 years. According to the most recent data from the Bureau of Labor and Statistics, nominal personal income, excluding extended unemployment benefits, has barely been positive. Net of inflation, real income has actually declined. Gross domestic product is 70% consumption. The market has priced into itself the assumption of a strong rate of GDP growth this year. I'm not sure how we can expect consumption to increase with a decline in real purchasing power and the potential for higher taxes on the horizon. This is of concern to me because we are just off an all-time record high set by the market in mid-August.
Okay, so you've touched on two areas of concern, and the news doesn't seem to be very encouraging. Well, you mentioned risks that are political in nature could be part of this equation as well, correct?
Yes. Let's take one more look at the slide upon which I have categorized these headwinds. So far in 2021, Congress has promulgated $7.1 trillion of new spending. Roughly $3.5 trillion of it remains up for a vote in the form of an infrastructure spending bill. On Monday, our Treasury Secretary Janet Yellen encouraged Congress to be mindful of the crises they are trying to resolve without creating a new crisis that is financial in nature. The more Congress spends, the higher the debt ceiling is raised, and the more debt we amass. That debt is in the form of new Treasury bonds, of which the Federal Reserve has been the largest purchaser over the last 2 years. The Federal Reserve has already expanded the M2 money supply by 36% since March of 2020, and they continue to print money to purchase $120 billion of Treasury and agency pieces of debt. With each newly printed dollar, the currency is debased to a greater degree, which means the dollar continues to weaken and inflation becomes of greater concern. The Federal Reserve has a dual mandate, and the most important being the control of inflation. I fail to see how they can be successful in meeting this mandate when spending remains so elevated and the printing of money continues unabated.
So David, what is your high-level assessment of the current environment, and what advice can you offer to our viewers today?
We are just fractionally off an all-time high across market valuations. There are many geopolitical risks in the world that could devolve into more worrisome and problematic situations. Inflation is at never-before-seen levels. Real wages are not keeping up with sharply higher inflation, and thus consumerism is likely to be affected. Consumers will likely curtail purchases of discretionary items, but not necessarily toilet paper and toothpaste. The Fed keeps printing money, and the dollar continues to weaken, and the Biden administration is rolling out ambitious plans for tax reform. The Congress continues to spend money with impunity. None of this is conducive for economic expansion. Personally, I believe that we may well find ourselves in another recession within the next 18 months. And for reasons that I'll cover in my podcast, it may be a shallow recession that lasts for a long time. As I've said in many other occasions and videos, this is a marathon and not a sprint. This is no time for an autopilot approach to investment management. Economic conditions change, but with change comes opportunity, and you need to be mindful of not only when, but also why an allocation change might make sense when the data is sending a clear message.
Well, David, as always, thank you so much for this helpful information. And for additional information, David may be reached through the means listed upon the following screen. As always, I'm Brandon Dawkins for the Trustful Tribune.
David Guttery and Brandon Guttery independently offer securities and investment advisory services through Ameritas Investment Company, LLC, member FINRA, SIPC, and Ameritas Advisory Services. Information provided in today's segment is gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed and should not be interpreted as tax or legal advice. Any performance stated is past performance and is not indicative of future results.